Hey, for doing this practice in our second segment, what I've provided for you is this trial balance as of November 30th. The Word document, it shows here that we've got a couple transactions in December, and then we're going to do some adjusting entries. I also have some in here that are correcting entries, so we're going to kind of see how to do that as well, even though we didn't really talk about that. They're similar to correcting entries, but they have an extra little step to them. But before we start, whenever you're given a new company, what you need to do is pull up a blank T account sheet. So go ahead and do that if you don't already have one up. Pull that up, and what you need to do for the next few minutes is, and I'll pause the video, I'll get it started, and then I'll pause it. But we need to put in these balances as they are into the right area and put those into our T accounts, because those are our opening balances. That's what the company had as of November 30th. We can't just start with zero because that's not accurate. This is an ongoing company. Now this one, I have this one here. This is one of the errors, and you might be able to even notice that by now this far into the class, that we shouldn't have an asset in the credit balance. And when we come down to doing the supplies, you're going to see that there's a no in that. Well, we're going to have to temporarily take out that no because the former accountant that we took over for this business didn't know and has a credit there when obviously it shouldn't be a credit. You should never have a credit balance to your supplies. So we're going to be fixing that as part of our correcting entries later on. All right, so the first thing that you need to do, and let's go ahead and start doing this. You have your opening date as your balance, and we have cash at $35,100. And then we want to keep coming down and filling in the rest. So our AR, we can take this and make it K Smith. That patient owes us $700, so we'll put that into his opening balance. Then we have some prepaid advertising, so we'll just change the name of the prepaid rent to prepaid advertising. Our balance, $800. Supplies, we're going to take out the no and put over here $1,600, knowing that that obviously isn't right. For our equipment, we'll put dash car. Our balance is $25,000. And then our accumulated depreciation, it says for the car, we've already have $15,000 starting. So what that tells me is, if I look at this without even looking at the actual instructions, this is probably done on a 5-year basis, $5,000 every year. That would probably make sense. And that we've had the car then for 3 years. 5 and 5 and 5 would be 15. Now that's could be different, but that would be the most reasonable explanation. But we'll know for sure once we get into the word problem. All right, we owe GNC Company. Come up to our account payables. Our opening balance with them, $200. And then we have unearned revenue for a JCP balance of $2,000. And then we have an account we haven't used yet, a note payable. That simply means that it's a long-term payable and that I'm going to be paying it off over many months, probably years. And that is at $23,000. That was to purchase the car. All right, we're ready for our capital. If you're watching this as a recording and you need to slow it down, definitely pause the video. Don't just get frustrated. I know where all the accounts are and I go through them pretty quickly. I know that. But I'm also, for those that do get it, I don't want it to be too slow where I lose you because you get distracted and you get bored. It's easier for those to pause it. We've got the capital in there. Our drawing is $4,000. That's how much the owner has taken out, Dr. K, so far. Got an opening retained earning balance of $7,000. We're ready for our final two columns. We've got our revenue. Opening balance that we've already made is $7,000. That's for this year. The retained earnings, that's just a summary of all the years past. They just happen to be the same number. That's just a coincidence. And then our couple expenses. We've got interest. I can go ahead and rename this one. We're not going to use this. Interest expense, opening balance of $1,800. Got an account for rent. Let's go ahead and put that in here. Opening balance of $3,500. And then finally a wage expense, and I've got one of those as well. Now this one, we can tell that it's going to be an error too. Expenses should never have a credit balance. But the old accountant didn't know that, and he has a $500 credit so far in there. So something's going to have to be changed. All right. Now, if you don't have all these in, go ahead and pause. All right, let's go ahead and get into our entries here. For those watching this as a recording, you may want to go ahead and work ahead and pause the video at this point and then see how you do, at least on the first 5. The first 5 should be a review because these are just normal entries. These are things that happen throughout the month of December that we need to keep track of, and then we're going to go in and do the adjusting entries the second half. So for this first one on December 5th, we got to ask ourselves, what did we get and how did I get it? So we paid office rent for this month and the next 2 for $1,500. So if I'm paying for 3 months, do the easy division there, that's $500 a month of rent. So what am I getting? I'm getting right now rent, and I'm getting the next 2 months, January and February rent. So those will be my 2 debits. My next 2 months, and I just put these in numerical order. You could have put rent expense first as your debit. Just as long as your debits come first, it's okay. But I put the prepaid rent first, showing that I have $1,000 for January and February. And then what did I get? I also got rent right now for December. And then how did I get it? Well, we got it with payment of cash. We had to pay money for $1,500. Now we need to put these into our T accounts. First thing I see is I don't have a prepaid rent account, so I'm just going to go ahead and make this one a prepaid rent since I already have it available. We're not going to have inventory. We're not going to start that until next week. So we have prepaid rent. And this is on, I believe it was 12/5. Yep, 12/5. We have $1,000 of prepaid rent. We had rent expense on 12/5, another $500. And then I had cash on 12/5 of $1,500 to December 11th. Billed a client for basically doing our job. We are maybe like a psychiatrist. Billed client for consultation, T. Jones, $500. Key word here is billed. So that means we didn't get the money. We're going to get a promise to be paid. So that's what did we get? We got a account receivable. And this is for a different person, so we're going to have a different T account. We don't want to put it in the same one as our K. Smith. And then why is T. Jones going to pay me? Because I did my job as the psychiatrist. $500. All right, so let's go ahead and put these into our T accounts. We don't have a account receivable for T. Jones, and I'm running out of room. So I'm going to have to come down to the bottom and maybe make this one. Now what I would normally do, and it's not easy to do here because I don't like to put in space because then it messes up the rest of them. But if we had a good software, we could easily just put in new. I'm going to come down knowing that this is account 111. It should be up at the top, and I could rearrange them later to put them like that. This is AR T. Jones. And perhaps what we could even do, if it really kind of made you not make too much sense, we could add another little area over here, and I could easily move up this guy and put him where he's supposed to go. He's supposed to go up here with these guys, a T. Jones guy. And I think I like that better. I think I like putting it right there where it should be. So on this was on December 11th, 12-11. $500 is what T. Jones owed me because I did my job. All right, on December 14th, K. Smith, the guy who owed me from the beginning, he actually makes a payment of $300. So I asked myself, what did I get? I got cash for $300. And why did I get the cash, or where did it come from? Well, it came from K. Smith's account. He no longer owes me that $300. He owes me $300 less. So I'm going to come over here to my cash on our date of 12/14. We got $300. I got that because K. Smith no longer owes me $300. He owed me $700, and now it's dwindled down to $300, or it's dwindled down by $300. And then if you just do the easy math here, we have a balance of $400. So these are still review from last week, so that's why I'm going through these a little bit quicker. Paid employees $1,500, so our employees worked. We got the benefit of them working. So that's our wages expense. And then I'm going to credit the cash because I actually paid them. So what we got, our employees working. Why did they work? For money. So we come up to our T account, update our wage expense. And that was on the 20th, $1,500. And on the 20th, we paid money of $1,500. Now on the 30th, we make a payment on our car, $400, and then of that $400, only 100 went to the reduction of the note. That's not very good. That means 300, if you've ever made payments on anything like student loans, cars, a home, if you have a mortgage, most of the money that you make a payment goes to, interest. So we need to show this. We need to show what did we get. Well, one of the things, and this is kind of odd to say, but you got a thank you. You're thanking the loaning company for loaning you money. And the way you thank them is by paying them interest. That's how they earn money. They earn money by collecting interest. So you're paying them interest for loaning you money. So you got you're paying a thank you for loaning you money. What else you got? You got a reduction, a debit, so that's reducing your liability. You only reduced it by 100 though. And then all of it, why did you pay a thank you for loaning me money, and why did you get $100 off your bill? Because you wrote a check for $400. Let's put these into our T account. Not that one. Okay, we've got our interest expense. We already have an interest expense going. We're just adding to it now on 12/30. Added another $300. And I come over to my note payable. Remember, that was all the way down here in my additional liabilities. We had $100 taken off of our account. And all of it because I made a payment on cash for $400. Now we've got all the normal entries done. We are now ready to start the adjusting entries. So now we're at the end of the year, and we need to update our books. Everything that's happened that didn't really have a definite transaction. Right? So our first thing, we're going to deal with the use of our car. So we go back to our car T account. I'm going to pull this up as well. Have this up. Remember how I had said, I just kind of had made a guess. If we had a balance of 25,000 and a current depreciation of 15, it's probably going by 5s. And that's the case. Yep, the car, that we've confirmed it here, the car has a useful life of 5 years. It's already been depreciated 3. That was kind of our suspicion. 5, 5, and 5 got us to 15. This is the 4th year of the car. So if we have a 5-year life, remember, all you do is take the cost of the car, 25,000, and divide it by the useful life, 5 years. So that's 5,000 a year. So when we get to our journal entry, our first entry shows that this means that we got the use of our car for another year, depreciation expense. And then the credit, whenever we have this as our debit, depreciation expense, the credit is always accumulated depreciation. It's just how it always is. These two accounts always go together. So we come over to our depreciation account. On 12/31, our only thing we have, $5,000. And we come over to our accumulated depreciation and add in another 5,000. December 31. $300 of prepaid advertising was used during December. Okay, we got to go back up and to our prepaid area. So we got a prepaid rent, prepaid advertising. All right, we had $800 in prepaid advertising, but we actually got the benefit of some of that now. So when you get the benefit of something, that is an expense. So we come up to our expenses. We have an advertising expense. On 12/31, we got the benefit of $300 worth. And then, how did I get the advertising? Well, I didn't pay for it this time. I paid for that a long time ago. It came from my prepaid account. My balance that I had still, I've now reduced some of that. I've used some of it. All right, on December 31, our normal payday is January 4th. As of the end of this year, our employees have earned $300. On January 4th, they'll be paid $400. So they've made most of their money in December, but not all of it. So on December 31st, I need to show this amount. This is actually just extra information for right now. This I will need in January, but I don't need it right now. I need the $300 amount right now. So that's going to be my only entry. I need to show that I got the benefit of my workers working up through the end of the year, and they worked $300 worth. That's it. I don't put anything about the $400 because that's part of next year. So I'm going to debit the $300, and now I don't come to cash because I haven't paid them. what I do is I come to wages payable and show that I owe them the $300 for their December work. Again, that $400, that's just extra information. I'll deal with that I'll deal with that 400 total come next year into January. All right, our next one, completed a job for JCP. So if I completed a job for them, that must mean I owed them a job. So I come down and I look for where does it show that I owe somebody a job? And that would be here. I owed JCP unearned revenue, a job that I was supposed to do for them. They paid for it, they just hadn't received the work yet. Now the job is done. So I can update my T account and my journal entries. So what did I get? I got a reduction on what I owe. I no longer owe $2,000 of unearned revenue because I've done the job. I had a debit of $2,000 to my unearned revenue account. I owe them $2,000 less. And I owe them $2,000 less because I actually did the job. So on 12/31, I show a $2,000 credit to my revenue, and that my revenue account is increasing. Okay, I'm going to pause to give those in our live session a chance to catch up, and we'll start back up here in just about a minute or two. Okay, now, two of our last three are going to be what's called correcting entries. These are entries that were originally done incorrect by the old accountant, and we're going to now go in and correct them. The way to go in and correct something is typically you do it in two steps to actually do the correcting. You undo the wrong piece, and simply to undo it, you just reverse whatever the wrong piece was. So if the wrong item had a debit to cash for $1,000, then we would simply just credit cash for $1,000, and that would null out that $1,000 cash entry. So we're going to do that, and then the second step is to just do it the correct way. Do whatever the journal entry should have been. Now, to do that, to undo that bad first entry, we actually need to see what the wrong entry was. So that's one of the things I'm going to do, and I'm going to do it way out here to the side so we know that this isn't part of our actual work. Our actual work goes here in our actual general journal, but out here to the side, this is just me kind of putting it out on a separate little scrap piece of paper so I can visualize what happened with the old accountant. I'm going to have this out here. It's not really I'm not going to do anything in my T accounts with it because this has already been done. This is just me scratch paper out here. So it says the original entry for the supplies was an error. And we go back to our supply account. And remember we had said to put that, even though it's weird, to go ahead and put that in the weird spot. So yeah, we know that it's an error. Now we just need to figure out why it's an error and to fix it. We purchased supplies. This is what happened. We purchased supplies from GNC on account for $1,600. However, the journal entry was originally listed as a debit to the AP and a credit to supplies. So what that's basically telling us is they did it in reverse. They did the wrong, they flipped it. They put the debit where the credit should be and credit where the debit should be. So how to fix that? We're going to pull up our answers, pull off our little side thing out here. So the wrong entry, old accountant, this is what they would have had. They had a, sorry for that noise, may have to go in. They had it says here they had a debit to the account payable for GNC for $1,600, and they had a credit to supplies for $1,600. And this is when they purchased supplies. So what they got, they didn't get a reduction on what they owe. No, they got supplies. So this should have been the debit, and this should have been the credit. All right, so now we're ready to go to our actual entries. This is what we did off to the side on our little scrap piece of paper. So our first thing we want to do is simply to undo and reverse this entry. So we're going to then, as our undo, we're going to debit our supplies and credit the AP to GNC. This is our reverse entry. We're just undoing it. We're undoing the bad thing that the old accountant did. Debiting the supplies, crediting our AP. And so that's where we want to come over here and actually do this, now that this is part of our real work. I don't put on the scrap, I don't put in the T account what we did off to the side on our scrap sheet. But I do put the 1,600 here. And so what, hopefully you can see what that does, is that just zeroes out this account. It's back to zero, like where it was before this entry even happened. And then we come up to our AP to GNC. And on 12/31, we credit $1,600. That puts us back to owing, it looks like we originally owed $1,800 to GNC before this entry even took place. Now, all we've done so far is just undid the bad thing. We now have to update to the real entry. And you might be able to see this already, but if not, the real entry is exactly the same as what the undid entry was. When we undid the entry, we should have debited our supplies by $1,600. So now our supplies, instead of it just being zero, which it is now, when I cancel out the old thing, now we're putting in a new $1,600 to get us to our actual balance. So this was zeroed, and now we have a $1,600 balance is where it should be. And we need to put in $1,600 where it should be into our AP. So we have the exact same entry in this case. Whenever the journal entries are simply just flipped, you have to do the same entry twice. Undo the wrong one, and then put in the right one. Okay, we've got 2 items left. This one is just a regular adjusting entry, nothing to correct here. But when we look at our supplies, it says we went and counted them out, and we only have $500 left. Okay, so right now, I'm going to add in a couple more lines so we can put this in. Right now, if I was to balance out my T account, my balance is simply $1,600. These guys canceled each other out. That was zeroed, and now I just have $1,600. But it says that my real true balance when I'm all done should be only $500. So we were at 16 where we, after doing all the corrections, but we really don't have 1,600 anymore because I've actually used some. This is where the adjusting entry comes into play. So on 12/31, I need to figure out how much supplies did I actually use. And just by doing the simple math, you should see that it comes out to be $1,100. I used $1,100, so that's got to be my debit when I come over to my supply expense. I don't have a supply expense already going, so I'm just going to create one. Put it in here, supply expense. For $1,100. And here's my journal entry. Now the last thing we see is there was an error to our wages. It says the November entry to the wages of $1,500 was incorrect. The journal entry showed, and let's go ahead and put this out to the side, out on our scrap piece of paper, way out here, so we know that it's scrap. The journal entry was a debit to cash for $500 and a credit to our wages expense. All right, this journal entry was all kinds of wrong. Not only did they use the wrong accounts in the wrong places, they flipped them, they also used the wrong amounts. It was supposed to be $1,500, but they only put $500. And they credited wage expense. You never want to credit an expense. All right, so it's our job to come in and fix this. So the first thing we got to do is simply reverse this. Our scrap piece of paper out to the side, we need to do a reverse. So we're simply just going to debit our wage expense and credit the cash. And that's what I did here in my real entries. Debit the wage expense and credit cash. So I need to put that into my journal or my T accounts as well. I'm going to add a couple more lines. So on 12/31, we need to show that we had a reverse. Debit the wage expense, credit cash as our correcting entry. And then we need to do the correct entry. What should the entry have been to show that wages were paid of $1,500 for work done? So the entry should have simply been debit wage expense for $1,500 and credit our cash. So let's put that in. Debit our wage expense for $1,500. Credit the cash. $1,500.